Hello from the children of planet Earth. Hello from the children of planet Earth, 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 Earth. Hello from the children of planet Earth, 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 Earth. Hello from the children of planet Earth, 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 Earth. Hello from the children of planet Earth, 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 Earth.
What's up, everybody? Good morning. Christmas lo-fi music. Let's see if it's worth keeping on. I mean, do you like some Christmas music? Good morning, team. Sounds like we have a pretty light week this week. What's up, everybody? Good morning. It should look like there's a little bit of snowing here. I know, right? I'm like, we'll do this. Let's try the Christmas song for a little bit. Oh shoot, market's already open. Hello, let's get ready to go. Good morning, everybody. All right, let's see what we got. Opening the door right here. Market's opening. We have DD band push. Market looks pretty stable here. Yeah, VIX has been trading down for the month, obviously with no volatility. That's looking pretty clean, I would say. All right, we're looking at BLU hedge pressure support. I think I like what I'm seeing. Maybe we should try it. I do. I think I kind of want a long here. Resiliences are positive. Things are looking solid. Should probably take a long too. Where's VIX right now? VIX is okay. Well, VIX is in bull zone, so let's be careful on this one. Nasdaq's looking clean. S&P's looking clean. I do like what I'm seeing. Let's see if we get a bounce on hedge pressure. Might take a long here. Resiliences are looking strong. Set supports at the box. We're pretty close. It's either a now or never. Open right HP. Yep. Let's see what KKK is doing really quick, just so I can get a feel. Commit. And bull zone, that's looking pretty solid. Let's give it a second, let this develop. See what's going on. Qs, resilience positive. Doing pretty okay here. Why not? Oops. Let's pump it here. All right, good. Pump it. Pump it. Pump it up. Let's go, Wall Street. You know, you guys. Any major banks out there? Love the stocks. See if it goes. We've got a 15 point, 10 point stop 1v5 to 1 trade. S&P's resiliences are still positive. Looking to support right here. Boom, 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 boom. Hedge pressure. Hedge pressure opens pretty clean, easy trade. CD ban. That's the rule. Nasdaq saw some reminded CD ban, so it's got a little place to go. If res greater than 0, obviously support outside the box. That's where we're going here. Res greater than 0, ED greater than half. Obviously we have the support here, but of course it'd be a hedge pressure break, so the DD rule, as we have talked before, is going to get a revamp right now, as we've done with one of our back tests. We kind of have some numbers now, some addendums to our process. Is that the DD rule, bull zone support, we no longer utilize on irrational markets. We don't even consider it a viable trade anymore on irrational hedge breaks. So if we were to break hedge and come through here, I don't buy on DD ban, on DD rule anymore. Monthly map's looking super bullish. All right, let's check them out. See what we got. Yeah, so it's the first day of the month. The most important thing is to take a look at monthly maps. Bullish, no volatility, at least for the first week. That looks looking super great. Well, SPY is not looking bullish. It's actually looking like there's some expected volatility coming up. That's a little interesting to see. We'll see if this is just a remnant of maybe the rollover. So we'll see into the new month. We'll see if this continues, because this is a sign of some volatility to come. So be careful here. Resilience trying to be wonky. Yeah, that's what we are looking at to see if it holds up there. Now I'm going to bet and expect that it holds up. Right. It's fighting there. Let's see which stocks are kind of being funny. Apple's always my go-to to see. Apple seems to be like resilience's favorite friend. No, it's not Apple today. Let's go ahead and actually just do... Let's check them all. Let's do distance to half cap. Let's see which big dogs are right here. Which stocks there? Right there. I'm just trying to see which stocks are ones on half cap edge. Apple has hedge twister bouncers. So let's actually watch and make sure Apple stays stable. That's all I really kind of like to see today. Let's take a look. I think they're looking pretty stable right now. This looks good. So as long as the resilience is positive, I still feel pretty okay. I can also take a tight stop here if I wanted to. Just hold on one second, guys. All right. All right, so things are looking pretty stable. I still think I believe in this. It doesn't look too bad. Resilience is looking slightly on edge here, so be very careful. Just see if it rescues itself. I'm gonna look for actually just do hedge breakdown because we gapped up. Let's see for hedge half gap breakdown. And we'll do this to sort for any stocks that are breaking down to the downside. Let's sort by distance of half gap. Just watch which ones are on the edge there. I think we hit 4,800 today. I think so. 72 tickers have broken down half gap on the S&P side. So we'll make sure we'll watch these and make sure this number, if this number is going up or down, obviously you'll see resilience will change. Looking pretty solid here. So my expected trade today, that's what I'm looking for. Res less than 0 is kind of that one spot that's kind of having me, that's kind of a caution right here. That can dip us to there. It's just a 10-point dip if we don't get it. But I think starting off the I think that there's like a psychological barrier here. The market's gonna try to want to at least test it. I don't think we see anything that's alarming today. Let's see what we feel like here. What's QQQ still doing? All right, so giving out QQQ bull zone as well, just to see if anything happens here. Now remember how liquidity pockets work. So remember, bull zone support typically happens. This is on S&P, it was 96% of the time, right? Without a hedge break. So far, we have not had any irrational to the downside. The SPY break is to the upside, actually. So with all the lights being green and the break is to the upside, the probability is really high that we do bull zone support here. Does everyone understand that? Now, resilience being the one thing that's given us a little hiccup. It's right on the edge and it's not collapsing just yet. So I think we're looking pretty solid everywhere. Don't forget, smash the like button. Let your friends know about the stream here. Give us a little bit of love. So since we open at hedge pressure, we open slightly below it, as you can see. Now, keep in mind, if you open on hedge pressure, then it's not considered a break. You're considered above it. on the line is over the line in the direction that it's moving according to is that like how the rules are in tennis? Is that tennis rules? I don't play tennis. So if they were opening exactly the same place and it pushes up, it's on a hedge break. It's considered over the line. So if they're opening exactly the same place and market pushes up and then comes below, then we're like, okay, that would be a break. So it's like the first direction it takes. All right. Don't like seeing this pullback. Keep your eye at QQQs. I'm not there. Oi. Ooh, ooh. All right, guys. All right. All right. I told you guys, click the like button on the stream. I'm gonna turn off my screen for 10 minutes. Y'all do that every morning. I'm gonna go. I don't know. Go water my plants. Be back. 10 minutes. Do it every morning. All right, I'll give you all a break this one time. Don't do it again. So it gets to half the people. The number ratio be half. I'll put my screen back on. Let's see what we got here. All right, so let's read the news. Can see if there's anything going on this week. Important. We're almost there. Almost there, you guys. All right, Paris. What's going on here? This week. It's also Christmas week, so it's probably gonna be a lighter week. Building permits, Atlanta Fed now. Fed GDP now. CV consumer Wednesday consumer confidence number existing in home sales. It's coming out. GDP, that's a big one I'd say for Thursday. So this is gonna be a pretty heavy week. PC on Friday, plus new home sales. So I think this is a pretty heavy week for economic data. I think we're gonna have a pretty solid. All right, we're going forward. Within 5 minutes of the stream, if the ratio of likes to viewers on half, I'll just end the stream and I'll cancel the Zoom webinar. That's what I'm gonna do. That's 2 hours of my life. If you guys want to save 5 seconds of your time, I'll save 2 hours of my life. I'll get paid for this. Oh, I'd love to sleep in. That'd be great. We're sitting here right here. Let's see what we get here. I know, I love you guys. I always got to remember. So we're getting our last little bits in the marketplace. Our soft launch is supposed to be in a couple days for one of our test vendors. I mean, I don't know, Russian Snicky. You sound like that vendor who we subpoenaed their trading records. Ooh, that was really... That's gonna be really fun. One second, you guys. All right, guys, looking pretty good here. I think I'm still good on the long. I'm not really afraid of this. The resilience is the one thing that has me a little concerned. But I think it's gonna make a run for it. I think the market's gonna push for highs today. I think at 4,800 would be great. How's it going? Looking good. All right. No, hold on. Oh, trade's going off pretty good. Oops. happened to music? Oh, my YouTube crashed. Hold up. Hold up. Give me a second, guys. Trying to figure out how this works here. Oh, really? One second. What is this right here? What is this? Alright, I'm trying to figure out something really quick. Oh, here it is. All right. So you'll see how I did the analysis today was pretty simple. Resilience had somewhat of a scare, but at that same time, it wasn't really too bad of a deal. Trying to go below zero is the only thing that was jolting the market. How's we doing? Trade's looking pretty okay. What is the yellow line resilience? So the yellow line is monthly hedge pressure resilience. Has to do with the percentage of stocks that are trading above their monthly hedge pressure, or percentage of market cap trading above its monthly hedge pressure or not. So at monthly hedge pressure itself, just like at half gap itself, resilience is a tiebreaker. Resilience is your tiebreaker at the stash line. If this is above 0, then this is above that line. Same thing on monthly hedge pressure. I have it turned off right now because it's really far away and it just crunches up the chart 451.5. If the S&P gets here, then that yellow resilience is the tiebreaker when you're there. That's what it's used for. Stretching. All right. Pretty solid here. Didn't get another 10 points on this trade. I think I'm pretty good here. Remember that 47.70 yellow line is there for support. Got all the things pointing up today. I think I like this market. Actually, I think I love this market. I think I'm in love with this market. I know we just met, but I don't want to move too quickly. I think I'm falling in love. To have a Zoom or another live stream platform for paying members? No, like the live stream. The live stream is public, so we don't do live stream for paying members. Yeah, Vishal, we're like the live stream is just me using the platform. Ashton does a Zoom call in the mornings. But yeah, we do this here. There's only the delay's only probably like 5 or 10 seconds, but even so, it's not. You're not supposed to copy trades. It's purposeful. So, does the Rocket Scooter training come with videos on how to trade? There are some futures videos, yes. It's the same as the S&P. There's really one specific technique that is futures. I guess let me start over. There's a lot of videos on futures. How to convert liquidity map from the equities world to the futures world. You do it just like me. You have two screens open. Maybe today's Zoom call will make it to where it's like that. We'll specifically make a video on futures related to this. I'm watching SPY. I'm trading S&P futures. So on the left, I'm watching SPY. On the right, I'm trading the futures. See that? So 471 is my support, and I'm just trading futures with the pivots. I'm looking at one for the level. It's here, and then I'm putting a line right there, just kind of marking it. Yeah, unfortunately, I know some people, part of a trade room service, I think, is that people pay for someone's call outs and all that. We're not a trade room, we're a trading platform. So it's a little different here. And we make the stream public so that everybody can enjoy it and see the platform in use. But also, we want you guys to be really good at the technique. All right, let's see if this picks up some steam here. Resilience positive, Nasdaq resilience positive. No red lights for an S&P hedge break to the upside, which is always a good sign in a bull run. We like those. We've got that yellow line support on the S&P futures, 47.70 in the pre-market. Holding that up. That's looking solid and tight. Let's see all over here. Everybody see how that yellow line support, just like right up here, going. Can't argue with that. Looking pretty solid. I like it. See if we hit those DD bands. Nasdaq DD band will be the first one we tap, though. That is going to be at a 16,931. Let me type it in chat. So to answer your question, Vishal. Oh, you're Vishal from chat. Let me message you, bud. Hold on. I see now. Okay. Okay. So we used to do a Zoom call trading session, but then we realized, like, you know, it's in reality, everybody here is using the platform for different means, right? Everyone's trading different things. It's not like a trade room where like my trades are particularly important. I'm just demonstrating how I use the platform and make a trade plan. When you guys are trading and doing your own thing, obviously the goal is to train and teach you how to do it yourself. And instead of breaking away and having a separate Zoom call, we just elect to do it here. That's a great question. Because there is a delay. I'd say the delay could be up to 10 seconds, maybe, at times. But in reality, you know, the setups are pretty clear, and I always describe them before I make the trade anyways. So it's like, it's kind of a moot point to be exactly on the moment I make the trade, because you already know what I'm going to do. I always say what I'm going to do anyways. So if your goal is to, like, I want to know what Matt's doing when he's doing it, but YouTube has a native delay, right out the door, I'm already drawing the trade plan before I even execute. Like this one, I probably was talking about it, I think 4 minutes in, and then I executed right here on this red candle. So, I mean, you get plenty of leeway. You just got to be here exactly when pre-market, you know, we open about 10, 15 minutes early. Hang in there, baby. Come on. 47.90 hitting some resistance again today. That was where we are the last couple of days. Let's see, we're here on some Thinkorswim. QQQ has that upper DD band. It's that target we're looking for. Nothing's really bumped into a resistance yet, so I still feel pretty okay. VIX is trying to do something. Oh, which, by the way, okay, so tomorrow is VIX expiration. Let's not forget that. Tomorrow being the Tuesday before the third Wednesday. This is one of those times where VIX expires after, VIX monthlies expire after the S&P monthlies, because whenever you have the week start on a Friday, or say the month start on a Friday, your third Friday is the third Friday of that month. Your Tuesday before the third Wednesday is actually the second Tuesday. So, I'm sorry, let me start over. The third Wednesday comes after the third Friday. That's where I was going, trying to say. Hold on a second. How to convert to ES? Okay. Yeah, there's a quick way to convert. Well, the easiest way is to not convert, because if you think about it like this, S&P and NASDAQ, they trade S&P futures and the NX trade at different rates. So like they're not necessarily ticking one for one. So the easiest way to do it is to make a spreadsheet, and you'll make a cross multiplication. It's that simple. You'll take the S&P value now, ES now, divided by SPY now, make a fraction of now. So you're going to do, I'll put 0 to me now or not. So an example is this current price and this current price make a fraction. They move at different rates. So the fraction is roughly equal to 10, but you know, it's like 9.98, 10.01. It bounces around, but it's like that. So then what you do is you take, you know, that fraction, you take whatever value you want. Let's say that you have a SPY hedge pressure, 471 hedge pressure, SPY. And you want to convert it to an effective hedge pressure in futures. You just cross multiply. It's your basic algebra stuff. So this fraction times that number equals that. So, you know, cross multiplying, just simple as that. The problem is that this number dances around. So any converted value will also dance around. And imagine if like hedge pressure was right here, it would like move around like in real time as the fraction changes. Does that make sense? Like it would jiggle if we were to do it. So while it's static as a 471 basis because it's calculated in equities, to convert it to something that has a moving ratio, the number itself would move. Does that make sense, Debo and Laser Chicken? So that's the easiest way to do it is to just look at this one and then watch that one and trade that one. So when we do the conversions, because of the dancing effect, we don't convert one to the other. Instead, we look at them side by side. Now, if we were to do a conversion, for instance, like if you're trading SPY and what is the DD band, which is a futures calc in SPY, it'd be the same thing. It'd be some dancing little line that would just kind of jiggle around as the ratio jiggles around. So all of your stuff would dance around. Imagine zones, half gap, hedge pressure. You'd have a bunch of things over here that were constantly moving around in real time. So platform would be slow. Your resources would be hogged up. And so it wasn't an effective solution to do that, if that makes sense, you guys. So the idea was we were going to create down the road some kind of algorithm that would only refresh and update the lines when you were close to them. So they wouldn't dance around that much. An example is if hedge pressure is here, instead of my eyeballs and us redrawing it every second for you towards everything is jiggling around, because we're trading far enough away from it, this only updates maybe once a minute. So it's kind of static most of the time and it updates again. But when you get close to it, the frequency updates in real time. So that way you're like, when you're getting close to touching it, you want to know exactly where it is. So it only updates here. And maybe if this was trading here, that one would be static and these would be static. So the goal was whenever you were closer to a line that would be a converted target, that line would then update more frequently the closer you are to it. That makes sense? Like distance is infinity, distance is 0. Like a transform like that, meaning that as soon as you get closer to it, the frequency goes up. So the further away you are, it just drops off and doesn't update. And when you get really close to it, the updates start ticking really fast. And that would be a solution that only something you're close to will dance around. But even so, it's complex on the resources, and as we think about it, even that's likely going to be a very busy solution. So in reality, it's best practice to keep them open side by side anyways, because you have all the available information. It's a less cluttered place. Like in futures, we have DD band as a target. In equities, we got to see the other targets based on other factors. So it does make sense to keep them separated, as the offspring would say. You gotta keep them separated. Just for simplicity. Yeah, because like honestly, it's like a liquidity map is its own thing, right? And so what if you saw green lines, yellow lines, red lines, which are all futures calculations too, on top of this chart? It would just be one giant clusterfuck, and it'd be not as clean of a view. Like my brain, because they're separated, it's telling me, okay, oh, in equities, there's unbounded. There is no resistance there. That's great. And then I say, oh, well, futures, there's something there. Now, it would be nice to have them all in one place if, in general, but we'd have to come up with that solution. And I think that's okay. But even so, it's having one extra chart to have them both here makes it clean. So I'm like, okay, in futures, there's nothing in the futures world in the way. Good. There's nothing in the way of equities world. So I'm like, I'm forcing myself to see it from two different angles anyways, which is, I think, good practice anyways. But automation would be kind of cool. You've determined, Alexander, I've determined 1 point is approximately 10 cents of movement. Ah, very astute, Professor. The conversion as well, I mean, it's just basic cross multiplication. So like, let me see. Oh, I don't have my thing open. I used to have a spreadsheet that did it in real time. Sorry. I have a spreadsheet that does it in real time for the dynamic calculation, but it's just not open right now. The fraction changes like point, I don't know. Let's see. If it's 10, it changes between like 0.5 and 1% sometimes. There's like 9.99, 10.01, 10.1 sometimes. So it won't be like a clean, simple, that's just the thing because they trade independently, right? And the granularity of the tick size is slightly different, as in each tick in futures between each point, there are 4 ticks between each point. Whereas with the S&P, between each point times 10, there are 10 ticks. What I mean by that is there's no even granularity. If I were to take SPY, pretend it's a 10-to-1 ratio, and I take SPY 390 and I take S&P 3900, right? And then they were pegged and they were tick for tick. Well, 3900, if it goes up 1 tick, it's 3900 point. So if 390 goes up in price, it can go up to 390.01. SPY doesn't have a 01. That would be 390.1, but this moves in quarters of a point. So if this goes to 390.01, this would still be 3900 because it would round down. If this goes to 390.02, this would be 3900.25. It'll round up. So the interesting thing is, even tick for tick, there's not 10 ticks between each penny. 0.01, right? This still moves up 0 because you don't have a tick size. It's equivalent. So the fact that the tick frequency is, you have 10 for every one versus a quarter for every one. Even if you had them perfectly on top of each other, they would still dance. Even so. Does that make sense? So because of the rounding. So if the S&P moved up a point, or sorry, SPY moved up 1 whole point, you would think that would be, or sorry, 1 whole penny, the S&P futures wouldn't move up because there's no penny denomination that's quarter, or there's no 10-cent denominations. So the interesting thing is that even that creates a dancing problem, even if the ratio was exactly pegged 10-to-1. How much money did I make from trading apart from Rocket Scooter subscriptions? I think I made $4 billion last year. I'm slated to be the richest man on the planet by next week. I think so. Well, it depends. If the S&P hits, and I'm going to get there $500 at a time. The S&P gets right there. How to get the data into your spreadsheet? Oh, James, there's a video I made on YouTube about how to get data from Thinkorswim into a spreadsheet. Allow me, sir. 1 second. I'll get away this year. I'll give you my tears. Or give you a beer. I don't know. What is the lyrics to that damn song? Does it give you a beer? James, watch that video. You can't get, I think, some mechanic, unfortunately. Ooh. Where else can you get data from? I don't know. Without you having to go and get a data feed. Is there any other platforms out there, you guys, that trade other platforms? Have the ability to do some kind of similar function like the RTD and Thinkorswim, where you can export data live from the platform into like a cloud Docker or spreadsheet. Rowan says every trading challenge, every dollar he loses a push-up. Hey, I'll be honest, if club life has taught me anything, being broke and sexy still gets you the girls. So that's all that matters. Although being rich and scrawny also helps get girls too. So either extreme, Rowan, he's still gonna get you'll be all right. It's win-win. You can't lose in the equation. It's a win on both sides. Without 25, wait, James, you actually have to put in $25,000 in Canada to even be able to use Thinkorswim? Okay, let me start over by saying this. I don't know the legality of this. That's to open a trading account in general or just to use Thinkorswim? You don't need, hold on, let me start over. Oh, you do need a trading account for Thinkorswim, don't you? No, I don't think you do. You can just use trading Thinkorswim for demo purposes, right? Do you actually have to open a trading? I don't remember if you can't just use the platform in demo mode. Ooh, at TD. So if you use the platform in demo mode, you can do it. Can use prop firms. Well, the problem is to get to the data. TD or Thinkorswim has an ability while it's open to use RTD to transmit data locally to an open Microsoft document, like a suite. When in the suite, like Excel, for instance, can connect and transmit data. Are there any like, I'm not trying to circumvent regulation, so don't take this with a grain of salt. Are there any like VPNs or something you can use to like get it? But if it's because I open a trading account, then it sounds like you can't do it. But if it's like they just block it in Canada, can you like a VPN to get it in a demo account? Or you have to have an actual trading account? If you have to have an actual trading account to use Thinkorswim, then probably can't do it. You can use demo. So Alex saying correct. So yeah, why don't you just do it in demo mode? Or whatever. Doesn't Thinkorswim have like a paper trading mode? As long as the platform is open, and the data's pushing through, that's all that matters. You don't need a trading account. Or Thinkorswim doesn't require you to keep an account minimum, so you can open the account and then put the money in, take the money out. Yeah. There's got to be some way to do it. Because you're not trading it. You're not trading it. You're just using the account for that purpose. So the date for the demo, it should be enough. I don't know if the data will be real time in the demo account, but either case, that fraction, like I said, it dances around. It's gonna be 10. Like if you're an S&P and S&P futures and SPY, it'll be like 10. like a couple tenths of a percent up or down. So whatever that fraction is, and the fraction's that, you don't, if you need an estimate, you can just use 10. So as Alex has said, it's delayed data. I knew there was going to be some kind of catch. That's it, delayed data. I'd open up more than one account. So there are videos in the Discord that tell you guys all of this. There are platform tutorial videos, Samuel, that walk you through it. All you have to do is click this button right here. So I advise you guys, before y'all start using the platform in the daytime, go train on the videos, at least the platform tutorials. It's physically called platform tutorial. But yeah, feel free to ask me any questions you guys have here if you want a quicker platform features in the Discord. So here, there's a video called literally right here, and platform features is literally the name of the title, and then you have multi-charts here. But you just click this little kick out button right here, can kick out any of the things into its own window. Like I can take this resilience chart, kick it out into a subchart if I wanted to move this somewhere else on the screen. Yeah, and as James and as Alex was saying, like the delayed data is good enough. And in reality, you can just if you want to really do it without Thinkorswim, if you're using delayed data, the fraction's no good. If it's 1 second delayed, the fraction's no good. If it's 20 minutes delayed, the fraction's no good. It's just no good if it's not real time. So in reality, just don't even do it. Just delayed data is not going to be any different than just doing the conversion at one random time, which you're just going to use an approximation of 10. You'll just divide. What we teach people is that if you want to manually do one, it's not going to be exact. You'll be off by, 1/10 of a percent or something. You just divide S&P by the futures at exactly any arbitrary time of your choosing. Before market opens, pick a time, or at market opens, pick a time. It's a dummy data point anyways, just to get the general fraction. With the S&P, that's easy. It's 10, so just use 10. You won't have the exact number of the conversion because you don't have the real-time data, but you'll have a number. And you can basically, if you want to do what the conversions group does, just go through and do that approximation for all the futures, and then that list never, and those numbers never change for you. Just use the same ratio as an approximation every day. So like whatever QQQ is like 44 or 41 or something like that, plus or minus a couple tenths of a percent. Yeah, like TD Ameritrade doesn't require you to have a balance in your account once you open it to stream real-time data. I don't believe so. He says, I'd love to be able to see past liquidity map of a specific date. Well, yeah, I mean, that's obviously something we'd like to build too. Being able to see it's a big project to draw historic stuff on the chart, and it's a resource hog, right? So that's another thing, is the efficiency of the platform is something we'd have to maintain if we were to draw. Imagine you have, cash up a year's worth of data. It's going to draw a year's worth of hedge pressures for you. It could be delays and things like it. It's a big project to do that. It's slated to be done. It's just not the highest priority, just because it's more of a cosmetic thing. Its applicability today wouldn't be necessary. So the history of that is going to be done during what we're calling the backtest project. So the backtest project is to make a backtest module at the bottom of the screen. You see the scanner and all that. There'll be a backtest module, and that makes sense at that time to address historic data and historic presentations. So it's like, the reason we're not just creating the project to optimize and just draw them, because it wouldn't be used by that many people except for you doing your own studying. And then if we're doing that, we might as well build the backtest module anyway. Yes. As Lee says, we'll need a ton of, hell yeah, dude, a ton of servers. Y'all gonna make me go broke. Just kidding. But that's the real reason. It makes sense to lump that sprint into the bigger epic of backtest, where all historic drawings, historic presentation. And another thing is that, like, you know, the vision for that is bigger. That backtest is going to be like statistical backtest. The arrows on the liquidity maps, for instance, would draw probabilities based on the backtest. It would like literally say 20%, 60%, like historic probability of this setup under these conditions. Like, it's a massive project, and it's literally called our AI assist mode. And so they're all a big part of 2024 development path. So I agree. But yeah, so I would say for your purposes, James, I would just do like the approximation route. Do like one day, just go in there and do all the conversions. Round to the nearest tick. Just manually go in there and grab them all from any platform. Like, what was SPY at 9:30? Okay, what was the futures at 9:30? Okay, let's divide them. Oh, it's 9.99. Okay, so that's 10. And then just make one list, and then that's your list. And then that's always your list. And then you can approximate within a few percent error the actual numbers. And you never have to change that list. It just won't be exact. It won't do that little micro dance that it does. But other than that, that's what the conversions group does. They do but they, in our Discord, the tab that says conversions, they do the conversion once a day at 9:30. So they actually do the conversion every day. Again, it's unnecessary to do that every day if you just want the approximation from one day to the next. It's an approximation. But what they do over there is they do the fraction every day, and then they convert the hedge pressures at the 9:30 basis, just for everybody that doesn't have that real-time data. And so you can go there and use the data they have. So they do a once-a-day calc. You'll do your once-a-day conversion just like that, or just go and get it from them. But you don't have to update the fraction every day, because the fraction is only useful if you do it in real time, so that you can actually fine-tune that exact level. Ooh, SPY trying to pull back a little bit. Come on, let's hang on hedge pressure. Things are looking solid. Data's looking good. There's no news coming out today that's really going to jolt the market. But while we're here, let's take a look at the Commander Traders report. Let's see how we're doing today on this bad boy. I know I'm being greedy because I want to make $1,000, not $400. The market is so fucking liquid. I love it. I love it. There's a hedge pressure balance. Resilience is still positive. We're still outside the box. Check, check, check. Good. No alerts here. Everything's positive. DD band in the way. I really think we're good. We were just rejecting 47.90 arbitrarily. NASDAQ and Russell are nowhere close to DD band, so there's a lot of room still for this to move. I don't hate it. If it breaks hedge pressure day for no reason, I would just cry myself to sleep tonight. Long's going more long. Short's going more short. The dealers are net negative. When you look at the way that looks, that's like this right here. The market is too liquid to crash. In that situation, it's almost always the same. It's like that situation right here. Market's too liquid to crash. I think we hit 5,000 probably by the end of the year. It's possible. Possible. But we'll see. Possible. Liquid markets do not crash. So things are looking great. Non-volatile liquid market. She's looking pretty. Why does this market hate me? Bearish will display ES and INSKey charts at the same time. Oh, James. Okay, so that is another thing. Yes, ideally that would be great as well. We don't have the feature. So futures is the one option that you can't. We can't do our futures data into multiple charts yet. We actually tried doing that. And it created a massive instability. It has to do with the connection of the main window and the CQG connection. There's a whole, it's CQG that created the issue. We have a workaround to allow you internally to create a second futures chart, but again, it's not a high priority thing. When we tried to do it, it created these big major issues in the test server deployment. So that is something that's gonna be worked out one day as well. You'll be able to open two futures charts. So you can open like multiple equities charts. You can't pop out a second chart in futures. Futures is unfortunately locked to the main window. Bearish CPI data, monitor policy heads, CDX falling and falling lower higher patterns. Again, rejecting from high. Feeling bearish in QQQ, Nasdaq SPY. If it follows the DAX, I would say that like in general, I'm not feeling bearish. It could be some sell-off days or weeks. The market in general is going to push. It's bullish as a whole. There's no, if there was any hint of selling pressure, the VIX would be picking it up. If there's any whiff of people being nervous or unsure of this market, you would see it in volatility. And even though it, like, well, I agree with you. In a trending sense, there looks like there could be some kind of pullback or I guess retracement, but that would only stimulate a second wave of buyers to push it higher. And I think because that's really known, right? The dealers understand that right now everybody wants to be long this market. Would you purposefully give somebody a dip to buy? And I think that that's why it's not going to come down yet. Volatility is just showing the stability. I think it's more likely to squeeze the shorts higher before lower if it does come down. Like this consolidating at the top feel of it just feels like it's still going to keep pushing. But I do agree with all things you're saying, Mohammed. I definitely agree. What is your pain threshold for exiting positions? Always one strike off of my entry point or my pivot. So for me, it's going to be 10 points below hedge pressure, which as you see is still a resilience play in bull zone area. So I would be very loose and try to stop below 470 even if it did. The R&R is definitely good there. It's 16 or 17 to 1 to 1.7 to 1, something like that. Hi Matt, don't you think including options flow in addition to the resilience would not only trading value, especially doing like but marketing value as well, options flow? I mean, yeah, we could jump on that bandwagon and create that tool. Our options flow tool would be superior to everyone else's because we have the ability to do things most people can't do. Most of the options, there's so many services out there that do like options heat map and options flow and order flow, and they'll all be inferior to what we'd have because we have different and better data, I'm sure. And we also have our algorithms that allow us to create a specific subset of that. And we can just look at market maker flow. And that would be a great marketing tool. Because our algorithm doesn't, we remove data from the options. So you can have like a specific dealer flow versus the overall flow. So we'd have a superior product if we were to make that. It's not a terrible idea. A flow tool would be awesome, but imagine that it's just like hedge pressure is not utilizing all options. It's selective as to what it believes only is held by market makers. There's conditions that each option is considered in the calculation. Each contract, each trade, everything's considered and thrown out or kept. So imagine if we created a checkbox you can check dealer flow and it just showed flow between you and the dealer according to what our algorithm would think was that kind of trade. So imagine how effective that would be to watch the dealer positioning change. No, nobody does desktop platforms and applications anymore, James, and not in the 2020s. This is the era of cloud-based deployment. Desktop app is a 2000s thing, like a Thinkorswim, and it's a clunky piece of shit that requires you to have good hardware. In your experience and my experience, someone else's experience is all going to be different based on how good our hardware is on our computer. Browser, however, uniform experience for all users. Cloud-based deployment means you don't have to download, install every time we update. The rollback process is a flip of a switch. And I just tell you to press F5 instead of close, open back up. We also don't have to develop in different environments such as Mac OS and Windows based and mobile app, Android. We just develop in one environment and you can access it in all the places. So a desktop app is very, very, very archaic idea. Companies like Thinkorswim and NinjaTrader are still, well, they're slowly becoming obsolete. No offense, I love them. Both of them are slowly become obsolete because of that model. A cloud-based deployed platform in a browser would be great. Now, NinjaTrader has Trade-of-8, which is their cloud-based platform that works in a browser. Trade-of-8 is a browser, if you didn't know that. When you open up your little... And so that's kind of the future of platforms. What Ninja did with Trade-of-8, or what Trade-of-8 did. Like, they're merged together as a company. But the little Trade-of-8 platform that you use, it's also in a browser, kind of like Rocket Scooter is. You just don't know it. If you didn't look at you open the console data, you see it's a browser. I'm sure all the major flow tools using the same supplier, just with different makeup. Let me satisfy your curiosity. I know everything about everything in that world. And I'll tell you some of the companies. Obviously, options data all comes from one source. That's it. There's only one supplier of options data on this planet. It's like electricity. Your city has a grid, right? But you got 10,000 different people trying to sell you that electricity as a broker, right? The options data construct is that same model. There's one supplier of options data. There's one repository of options data. There is one options data feed, period. Everyone gets it from the same source. But there's a ton of little middlemen that sell it. Now, there are only each middleman, there are huge, massive price differences between them. So what the middleman does is take the main options feed and do things like calculate Greeks from it, calculate other things from it, create tools for it, whatever, and sell those as packages to like vendors like us. What we do is we buy a raw data feed and we create our own rolled up version of it to read. And then we created all of our technology in-house to analyze. Now we have those middlemen groups. Typically, the majority of them don't even calculate Greeks. They just resupply the raw data. So what that does is it lets you know that all these options flow groups or whatever choose one of the 3 or 4 places in town that calculate Greeks in real time. Out of the hundreds or whatever of suppliers, there's not that many to do the Greeks. It's a massive infrastructure to supply real-time Greeks. If you guys didn't know that, when you open up Thinkorswim and you got a ladder that shows the Greeks, the thetas, the deltas, all updating in real time, Thinkorswim calculates that locally. That's not done from the data provider. The Thinkorswim wrote its own coding to calculate Greeks, which is why, you know, Tom Sosnoff didn't include put call parity, whatever newbie mistake that was, into the calculating of these Greeks. I don't know if they thought that was important. And the risk-free rate and the theta equation's also really off. I've double-checked, and Sosnoff's calculations are incorrect in those regards. But nonetheless, they are brilliant programmers. Not saying they aren't. This is done 20 years ago. And anyways, they calculate the Greeks on the front end because, again, at that time, data suppliers didn't supply them. So they had to write their own Black-Scholes implementation. And that is a massive, massive, massive thing to calculate real-time Greeks of every option, every contract in real time. So every order flow group out there doesn't do that. They don't buy that. They build it, they buy it. There's only a couple of data houses in town that supply real-time Greeks. Majority get, no, Jesus, everybody gets it from Opera. Opera is the only supplier of options data on planet Earth. There's only one place it comes from. There's nowhere else to get it from. Do I plan the data duplication problem? Are you talking about for futures? What do you mean data duplication? So here's what Opera supplies. Opera is and Opera gives very little as well. Opera just gives you the real-time time and sales of options trades. And then once a day, Opera publishes a report of the open positions of all people that are required to report. And that's basically it. It's very basic. Opera didn't give a lot, but from what they give is where all the wealth of options data comes from. Greeks and everything are calculated from that main feed. Opera is a fire hose of trade data. This option at this price sold at this time at this price. And it's just it's a flickering stream of information. It is so overwhelmingly large that you couldn't even stream S&P SPY, pick a ticker. You couldn't even stream SPY in real time. No computer on this planet could even handle that much flowing data and analyze it in real time. It is that massive of a data feed. As a matter of fact, they have a program that you have to use just to open up a static piece of data of that much for one ticker, just to test it out. So like, I think I picked like one day's worth of data and it was many, 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 many terabytes worth of junk. I mean, it's just like the data, and imagine the entirety of the options landscape blasting you in real time. No computer could process that. And I mean, that server process, fees would just be infinitely large. So the companies create solutions to processing and displaying that main data. Usually they're called like roll-up processes, where you have like imagine that you get this stream of data that like your data goes like this. Your data point starts here and it's a bajillion data points to go from here to here. But if you just knew that the transform was a linear line and you pluck the data point every 10th of a second, you can interpolate the interior of that. You can pull the data, and then you may not have the granularity of real time, but you can estimate based on a mathematical transform. And that's what they typically do. And so it's a math problem at that point. You use correctional math, like a proportional integral, like PID controller kind of thing. Like, even if something oscillates, you can forecast what it's going to look like, and then create a transform and then interpolate in the middle. Like the data that you buy from these middlemen do shit like this. You're never looking at the real-time feed, just because nobody out there is going to be able to supply you that much data that quick. They don't have this beefy infrastructure like that. It's a cool thing to know about, though. The limitations of it, just because there's the sheer amount of data that is all options trading at all times. I mean, just imagine, right? The time and sales. If you were to open time and sales in this S&P futures or Nasdaq futures, check this out. Like, imagine this. This is just one contract. See, like, this is just Nasdaq futures, right? One contract. See how quick it's ticking? It's just like just a massive tick. Now, think about this. Just think of QQQ options. Every single strike at every single date, at every single point in time, will have a feed like this just for QQQ. So you're talking a grid of hundreds of strike prices and months of dates, right? Imagine thousands of these for just QQQ streaming in real time. And then imagine 500 stocks with thousands of those each. Oops. So, oops, what happened to my stream here? That's just cool to know, right? So the neat thing about the data, the data world, is that it's just such a massive thing. So there's all kind of tricks that people employ to, like, for us to get liquidity maps imagine that. Imagine a liquidity map for SPY needs all of that data. The walls are considering all strikes, all options, all expirations. So for us to get all of that calculated and delivered to you in a minute was a feat that took a year to overcome, just the limitations of what you can physically do with the server of with the server and make it profitable. Like, how do we give you this information without bearing ourselves in server costs? And that was a very cool engineering feat. We solved it. But yeah, but anyways, just a fun conversation about data feeds. But everybody gets their data from Opera. The thing is that they all get them from there's only a couple of middlemen in town to play Greeks, and I'm sure they do that. Is all the options flow, order flow data. And actually, even so, the order flow data doesn't need Greeks. So they even go to a cheaper supplier that just gives you flow data. And they roll it up, they create like an average volume, and anytime the volume's greater than the average volume, it goes ding, 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 it's unusual, and then that's it. It's a very basic service that's getting a lot of clout right now, which is good. It's not a terrible idea. It's just, I mean, we could program it in a weekend, pretty sure. If something's unusual flow, you just have to define what usual is, and then create a threshold to trigger the unusual portion of that. I would say that the usual flow would be some kind of rolling average or historic average or something. And I'm sure that's where they all differ from each other, is what their static definition of usual would be. So we would create our own, and it should be very basic. But the difference between us and them would be we'd be able to use our same, because we take the options data and we throw out most of the trades that we don't believe belong to market makers. So ours would be, we can do a dealer only flow, which would be kind of cool, which would be like force hand trading between us and market makers kind of thing. We can come up with a cooler way to do it. Have I tried CBOE live vol? As a personal solution, you can use live vol. If you want to see, it's very similar to like Thinkorswim. You get the same ladder. I mean, not the platform, but the live vol. It has like the same kind of detail. You have a ladder, options, shows Greeks. It's a pretty cool program. Yeah, CBOE is a great supplier of data. Bloomberg also sells options Greeks, but that's not a feasible solution for for a business. But yeah, live wall's great. I've played with them before. Just personally. How we doing on the trades, baby? Heyo! Finally starting to get some movement here. Hedge pressure support looking great. Palantir. What's going on, Garrett? Palantir. Should get a blower to get this paint to dry fat, dude. I'm telling you. I've been over here doing some dances to the trading gods. So hopefully it's gonna work out. Can I explain in detail what it is for I decide to get a subscription? It's a platform that shows market maker and institutional positional data and risk. We draw arrows on a chart pointing at the flow of forced hand buying and selling based on algorithm that we have. Proprietary, groundbreaking, market shaking, universe disrupting, galaxy creating algorithm that reveals for the first time in the history of your life dealer and institutional positional risk and hedging, which basically means it's a window into what's going on behind the scenes at the casino. But before I give you a sales pitch, just ask the members here who already use it if they want to. If you have any specific information. On the left side of my screen, there are arrows that show where flow will happen. Forced hand buying and selling. On the left side, where I drew the arrows where I would buy and sell the market. I usually line my trades up with the flow. And what we do is we predict volume. So these indicators we create are volume prediction. So that's another thing nobody's done. So the idea is that if you can access where market maker or dealer positioning is, dealers are going to always neutralize their position, market makers. So at every price, you can determine where flow will be maximized based on where the risk of dealers are distributed in that landscape. So essentially that's a fancy way of saying you can predict where volume will be, because there's a huge volume spike when you interact with a lot of our pivots. I mean, all of them, like hedge pressure. Anytime you touch hedge pressure, there's a volume spike. You can see where I circle on my screen. That is a flux of dealer order flow. So you know where hot spots are going to be if you can predict where high volume is going to be. So then, like, I'm not trading arbitrarily inside of all of this. Today I've got one entry point. Today was hedge pressure, and that was an easy trade. I just held. This happened. I still held, and that happened. $600. That's it. And then I just line my trades up with the flow. Oh, yeah, you should check out the subscription. And we teach you, like, this side of the data world is unique. So nobody, there's not even a competitor in the ballpark of what we're doing. There's no one doing this other than us. So to have this type of technology is a whole new, like, I guess, endeavor. And we're pioneering this field. So yeah, no problem. And I mean, like, check it out or just hang out the live streams. You can watch them all. You know, we still take the stance that you can't predict the stock market. We slap technical analysis in the face by saying that technical indicators can't predict the stock market. Neither can we. Nobody can. But you can predict, or you can't predict price action in the stock market. But what you can predict is where volume will be. We do it every day. Every one of these pivots is predictable high volume with 100% certainty. Nobody can make a claim like that in technical analysis. We can make that claim. You can predict a volume spike, any hedge pressure break. Any hedge pressure break is a volume spike. I don't know if there's any that are broken today. Let's pick some random stuff. Here's Apple. Oh, there you go. Anytime you interact with hedge pressure, it is volume. And the idea that we can predict high volume with any stock, look at that's higher than the opening volume. Look at that. Any stock, any ETF, anything 100% never doesn't work. Nobody on Wall Street has ever been able to make a claim like that. But we can. It's mathematics. Anytime you interact with hedge pressure, it's a volume spike. I don't care how far into the day that it is. Now, the first volume spike is usually the biggest one as the balancing act takes place there. But any subsequent tap or whatever, there is just volume excursion. But really, that's the one you take a look at and see how it works. So the neat thing is that in all of the day, you just know that this is a high volume node on a volume profile. Looks like a giant titty. Let me just not draw it like that. With the nipple. That is a high volume node before it happens. 30 minutes before it happens, you know that your volume profile will develop right here. So you're having volume profile before it's actually developed. So like tomorrow, if you look at Apple, tomorrow, Apple will have a developed high volume profile, high volume node right here. But at 9:30 today, you knew that. You knew that if you got here, you would develop a high volume node there. So you're constructing the framework of a volume profile 24 hours in advance. It's like your brain is like, oh crap, there's gonna be a high volume node tomorrow. So people using volume profiles today are using yesterday's trading volume for today's decision. You're using trading that hasn't even happened yet for tomorrow's decision. You just like literally are one-upping people in every aspect of predicting volume. It's like the new frontier of trading indication is predicting volume. So this is hedge pressure. And so what hedge pressure is the maximum gamma of all options sold by options dealers to market makers of the underlying stock. It's a dealer-to-dealer transaction where both sides of that trade are neutralizing their risk. So both sides of that trade are buying and selling the stock to neutralize their risk to zero through delta hedging. Therefore, as price goes up, that group is longing. As price goes down, that group is shorting into those moves because that's how delta works. Therefore, at the maximum gamma is the maximum the math on this. So the maximized gamma, which is del delta, is the maximized change in delta, which is delta of the option underlying. So what this partial differential is really telling you is that the maximum gamma spot of just dealer, and this is just dealer to dealer options, maximize gamma is the maximum change in price of the option versus the change of price in the underlying. Which, if that makes any sense, when delta hedging happens, is that every single time there's a change in the underlying price of the stock, there's a change in the underlying price of the option. So the balancing act goes up, means that delta hedging is maximized when the gamma is maximized. There's the maximum amount of sensitivity to price change, which is right here, the maximum sensitivity. Therefore, the maximum order flow of delta hedging takes place at the gamma maximum of dealers of forced hand buying and selling to that math. So hedge pressure is a forecastable maximum order flow of dealer purchasing or selling the underlying to balance their risk to zero. And that maximized order flow is present in a volume spike. And we just call it hedge pressure because it's cute. And I'm an engineer. And pressures are fun. But it's the pressure from hedging. You have positive pressure, negative pressure. We think of pressure as a flow. When you think of flow, you think of pressure, at least from an engineering standpoint. I've specialized in a few topics in school. Fluid dynamics was one. I used to teach fluid dynamics at the university. flow is a thing. So the pressure being positive or the pressure being negative creates this like underlying current, if you may, that's just existing inside of the ocean of price action. That makes sense, I heart? So when you get right here, that maximum gamma means maximum change in delta. A change in delta is a change in order flow, where the change in delta at the price is the highest. Therefore, the delta hedging, the order flow, is the highest because it's the fractions are so the fraction the equation, the change in price of the underlying versus change in price of the option, is what delta is. So the bigger the change in the price of the underlying, there's the more order flow that made it move there. So that's what happens. So you get the maximum delta hedging at each hedge pressure. Walls is a whole different story, but basically what you're doing is all of our tools are predictable high volume or whatever, for whatever reason. I don't know. Let's pick another stock. Let's search for like hedge pressure breaks. Let's just pick some. Any MHP breaks? A couple. Let's do hedge pressure break in general. Okay, let's just find a couple. I'll just throw some random ones up to Uber. It's kind of hard to see this one. And sometimes the high volume spike isn't like it's a spike, and it may not be a big spike like you normally will see, but it will be somewhat of a spike. Like here, this is a tick off. Like this little ramp up is that little ramp up. This interaction point, it's a little bit higher, but sometimes they're not like giant spikes, just depending on, because that is the balance point. Just depend, there might not be that much risk there to begin with, but there is still that volume profile developing here. And even here you can see as you get close to it, the average volume is in decline, even though there's a couple of spikes here. As you get close to it, the volume starts to have a little bit of spikes, see, just like that. And this is an area of interest as well. And then there's the hedge pressure, and then there's the dump, right? So you can see the activity is creating, sometimes it's a gradual change, sometimes it's a straight up spike. But you can see the difference between here and here as you pass through, right? A lot of order flow takes place right inside of here. I'm just picking random ones from the scanner. Apple, we just picked one. Hedge breaks, not that many of them today. BLNK, okay. That one happened too close to the open. Might not be able to really see the spike though. Right here. Well, I guess it's a little bit. It's blended in with the open, but UNG. And that's just hedge pressure breaks, by the way. All of our pivots predict volume changes. Oh, this is a penny stock, so I wouldn't put too much faith in it. But here's the volume spike on hedge pressure break. It's really small, but it's definitely there. These penny stocks are very illiquid. There's where it's like no activity, some activity as you pass through it. And it's parabolic. So like if price were to pretend this is hedge pressure on my screen, if price were to do this, technically volume would build like parabolic. Well, here's the break, so that would be the peak. Like that. So this would be like the peak. And it's just like that underlying current of order flow that comes from just the hedging. Sometimes the natural market volume can be more than that. Sometimes it can be less than that. The randomness of the market but there's always that kind of hum there. And so we utilize that for like trading activity. Like this one didn't interact with it until the open. Again, that's blended in right there. It's kind of hard to see. We didn't touch it or cross it, so this isn't a good idea. Oh, here it is. Here's where we touched it. I mean, that's inarguable, right? So, I mean, well, you got close to it. But again, like I said, it's parabolic. So as you get closer to it, it's just spike up and spike down. Open and close are also high volume pivots. So this one didn't necessarily touch that one either. So that's not a good example, but you can see that AVGO, okay. Find some that have actually broken it. What about it? It's a simple bull long up AVGO. It's a bull long up with a positive like order flow, net positive, the long side. Anytime you open, and if resilience is positive, the S&P is going to trade up. If there's no catalyst on this, typically these are flexing the upside. Trade's going pretty well, 650. I'm looking to hit that upper DD band. I'll be excited to have that. So in hedge pressure being one portion of liquidity map, we use a couple other things called zones to go with it. Overall, the zones have to do with position. Like, so hedge pressure is options between two dealers. Bull zones are traders like you and me against a dealer. So there's different reasons for each one of them. You can see that inside the landscape, that's all got pivotable stuff in it. So the combination of zones and hedge pressures create liquidity map. Liquidity map creates like a flow to go with it. Man, I'm hungry. I go to the gym in a little bit. So today, an example like SPY. This is very clear. I drew my trade plan earlier. Let's see if I can maybe go back in time and just kind of, it doesn't go any further back then. Okay. So SPY, this is the open price. This is the hedge pressure in the open. We opened below it. So actually this 1B doesn't even apply today, but if you support at the open and you're above hedge pressure, it goes to next resistance. So we're supporting at the open. We're above hedge pressure. Hedge pressure is the support to next resistance. Next resistance is there. So now I'm going to say, okay, well, I have a trade set up from about 4780-ish, 82 to actually, sorry, 4783-ish to about 4800. So that's 17 points to the upside for my trade. And then I take a one strike stop below, which is 10 points on the S&P, which is here. I always take a one strike stop. So 17 to win, 10 to lose is equal to 1.7 to 1 trade. So I already have my risk and reward set up already out the door. I longed right at the bounce, and then I'm hanging on for the big trade. And then that's basically it. Then we use all these other tools for understanding bias. An example is, oops, let me go to the top of the screen here. Resilience being, or sorry, the CD ratio being 0.99 means 99% of the market cap of the S&P stocks are above a bull zone, which means under most normal circumstances, bull zone is also support for another role. That's the tracking between the SPY and its constituent stock inside of the basket. So not only do we have hedging flow pushing up from the blue, actually in the open, we also have really solid support there. So it's confluence from two different angles. Resilience is the strength inside of the gap based on the tracking of the S&P SPY versus the stocks inside of it. So when this number is positive, then this half gap is also support. So we got bull zone as support, half gap as support, edge pressure as support. So now, then I got 3 different places of support. Now my brain can say, well, markets are random, so I can long here. I can add to it here. I can add to it there. And I can just bet that 1, 2, or 3. I'm going to play all 3 hands. I'm going to add more, and I'm going to cut if it breaks. See how easy that is to make an assessment like that? So I've got 3 different tools that attack 3 different things. And when they all line up pointing up, I know that in general, the market's going to flow to the upper direction. And at best case scenario, it just goes straight there. Or worst case scenario, it plays around and dips and then maybe goes. Or it goes here, maybe goes. But either case, it's like I've got this range of adding to my position, but I know right here is where I lose all my support. So I'm cutting right there. So I can either, I could long some more, and then I can cut. So I know the difference with the setup, which is what makes our team really strong compared to anyone else out there, is that if the market started, well, let's forget the hedge break happened, but imagine that you started right here and the market fell to that. New traders would be trying to chase that short. Our folks would be piling in for a long because of a DD roll. So we know the difference between the markets selling off or just dipping in bull territory. And that's the strength of what we do here. As a matter of fact, markets are rallying and you want to jump in on this right now and say, ooh, I'm going to get it on the S&P. Well, what's your R&R? Where is it going from here? You don't just say, well, the market's going to keep going forever. I'm going to hold on and make $1 bajillion. As a matter of fact, when this thing bumps up and hits that, I'll be closing right about there once all the rest of the newbies are jumping in long, and I think it's going to kind of peg out right there. As a matter of fact, it might peg out a little sooner because NASDAQ is right at its DD band. So in just a little tiny bit, when NASDAQ gets to this green light, again, this is, you might be asking why the NASDAQ when I'm not trading it. That's what the classes are good for. As soon as NASDAQ hits that, I'm going to jump out on a SPY. So while I do have a specific target for the S&P, which is here, I think I'll probably be bailing early because of the NASDAQ. And that's basically what it is. So in all particular trades, I'm going to calculate my reward and risk ratio every time. Keep it simple. So right now my upper targets in futures are these green lines, and whichever one hits first is usually the out for all of them. So NASDAQ is slated to be the one that hits first. If you look at it. And so that's how it works. So SPY I've got. So does that make sense to whoever's asking where that person was? I heart. Yeah, open was technically BSU that broke hedge to the upside. Yeah. But yeah, correct. So now it's like, what's different is that I'm not chasing order flow. I'm not looking at weak technicals, weak momentum, things like that. I'm planning a trade before. As a matter of fact, I don't even need to see what the candles are. I don't even need to watch this. I know where I'm in, I know where I'm adding, I know where I'm out, and where I'm closing. So we've completely created a style of trading that doesn't even look at price. How crazy is that, right? You can even look at the price of the thing you're trading. What time frames, people ask? There is no time frame. We wrote around it. There's no multi-charts. There's no none. Multi-chart confluence is the stupidest thing that TA people sell you on to overcome the shortfalls of TA not predicting the market. And they still want you to think that it does. So they say, well, I mean, if you look at it on a 1-minute chart, a 5-minute chart, a 30-minute chart, an hour chart, put them all together, you'll get a better view of the market. And then maybe that'll work. And then that just sounds even sillier. Nothing can predict the stock market. We don't try to make that ridiculous claim because you can't. We built our tools around that fact. That is the baseline. That is our postulate. Postulate is a thing that's assumed to be true when you design any kind of thing. Like in Euclidean geometry, you know, everybody remembers the 5 basic postulates. Between any 2 points, you can draw a straight line. It's like things assumed to be true. Any straight line can be extended until infinitely, etc. So the postulate that we take is that you can't predict the stock market with price action. So imagine we built all of our tools off of that fundamental truth. Keep adding more variables and your results will get better. Or keep adding more handles for you to play with so you'll stay subscribed longer thinking that you made a mistake. Keep trying, keep doing this, keep doing that, and then you'll just pay longer because you think you're doing something wrong. You're gonna, as long as you mix the magic potion recipe, you'll eventually get it right. Keep trying, guys. Don't worry, you'll get it right. So our postulate is that you can't predict the stock market through price action. It's impossible. Well, technicals are great at what they do as long as they sell it to you correctly and saying, well, technicals help you see the market slightly better than price action alone. Price action is the best technical indicator if you want a technical indicator. But again, it still can't predict itself. That is where the logic flaw is. What is an indicator? Well, it's taking price and throwing some math at it and giving you another curve. Okay, so what is the, if you take, here's the thing. If you were to create if you were like, say, ChatGPT, make me an infinite array of correlations, of polynomial correlations that can take price and throw it through some kind of equation and create an indicator out of it. And ChatGPT goes, okay, I created you an infinite series of correlations. Every math equation possible, we've done it. And you go, okay, Siri, take that data set. I want you to integrate it from 0 to infinity of all equations that you have just generated for me that are a function of price across the entire set. And they go, okay, I took every technical indicator I could possibly make and I integrated them, right? I added them all up, created to create one master equation. And what you would do is you would just circulate, you would recircle back and stumble on price, which is the funniest part. So like if you take all technical indicators and add them up, you just basically recreate price using, you know, like any kind of, you know, sinusoidal, like Fourier transform or something. You'd get into like that. You take a bunch of waves and you create one wave out of it. Well, you can take every correlation you can make in the stock market and add them up. The best thing you'll ever achieve is price. Can't achieve something better than price. You'll just achieve an indicator that becomes price. So the idea that you can take price and create some kind of function of price that somehow is more predictable than price itself, when the sum of all functions of price equal price. So an incomplete set can't be more predictive than the set itself. Is a fundamental flaw in the mathematics. I've got 5 things in my pocket that are all different. I can make a better conclusion out of these 5 things in my pocket to guess the 6th one by just looking at one part of that. One piece of that is better than the whole. So that is where the failure is, and just the logic alone. If all indicators add up to become price themselves, then how is price not the best predictor of price? And therefore you incur on that infinite loop of price is the best predictor of price, which is the best predictor of price, which is best predictor of price. And therefore price should be able to predict itself, which it doesn't. So therefore you can have a postulate that exists in technical analysis where you can predict the stock market based on price action, because price can't predict itself. So therefore it's failure. So we built our tools on that principle, that price cannot predict its own destiny. Therefore, no derivative of price, no function of price can predict price either. So our postulates are those 2 things. Price can't infer its own destiny. Number 2 is no subset of price, no price, let's just do like subset, is greater than price of the whole. No single piece of this data point is better than the whole of the data points. Then they'll be right 50% of the time. So the idea is that price can't infer its own destiny, and you can't just take chunks of what you care to look at to get a better view of the market than all of the data itself. So like those two things are fundamentally true according to Rocket Scooter. And so therefore we built all of our framework on that knowledge that we must build around that. What is predictable despite those things? So technicals are great at what they do. They just can't predict price action. They never have and never will. Now, the thing that you can predict is volume, because delta hedging is the same in all capacities. If you assume everyone delta hedges, then everyone delta hedges exactly the same. Every change in 10 points in delta, you buy 10 shares per contract. That is fundamentally how everyone delta hedges. Therefore, you have consistency. Therefore, if you can find out where everyone delta hedges the most, therefore you can predict where volume flow will be. So now you can't predict the direction of the market still, but you can predict where activity will be based on this premise. And then we created the technology, we look at it, then we observe it, and we see that it's pretty much always correct. But can you predict, is it going to flow to the positive, negative side? Who's going to win the fight there? And the random part of the market can sometimes overwhelm it. So if hedge pressure breaks, if the generalized pressure of bull long up, which means all the things add up, is generally bullish from here, what happens if it breaks? Well, I can just get out of the way because the market should flow this way, but something unusual happened and we broke through hedge pressure. Well, what happened there? Well, no, it's the random part of the stock market. Somebody was selling in abundance. So all I know is that all things being equal, the best case scenario, it should look like this. And if something happens and we're down here, well, I know that I'm no longer going to play the long game. What happens from here? Nobody knows. Price action is random. You don't know, but I know where I don't want to be long at. So I can create zones where I don't want to be long, and I'm not going to buy the dip here. I might consider it buying it exactly there. But now I have like no man's land where I don't care to trade on, or danger zones where I can walk away from a trade I'm in. Any trades today? I'm up $600 in an active trade. Look, like I'm saying, we're big math nerds here. If I didn't play football, my brother was an all-star athlete, I would spend most of my time shoved in a fucking locker. Because I was definitely a geek. That's Captain Math Club, baby. Ladies, line up. That's sexy on top of sexy right there. So right now I'm waiting for NASDAQ or something to hit its final destination DD band. Right here is where I'm looking to get out of my trade. By proxy, so like if NASDAQ ends its journey, I'll get out of the S&P slightly earlier. On that note, we should probably call it a day. What's your entry point today? Just rewind and stream. I longed at hedge pressure on the first tap. Oh, sorry, on the first red candle. I longed right here. It went up, came down, so I was longing literally right there. No problem, pineapple. You're an Aspen? Dude, you're an Aspen? Oh, yeah. Are you skiing? And why are you trading? Get your ass on the slopes, bro. The next resistance is DD band. You better not be staring at your phone while you're skiing. Don't run into a tree or something. Get your ass out there. Don't be listening to my voice right now. You go out there and enjoy your winter wonderland, sir. I got you right here. Check it out. The next resistance. Okay, so when you do exit targets, let me show you guys really quick. So exit targets, we have a bunch of ways to find high volume pivots to exit the market. You go down here to exits. So the rules that we have for exits, let's go through them really quick. Liquidity pocket is one of the exit rules. Gap fills, when you fill old gaps that are open, is another exit rule. DD bands is an exit rule. Opposing walls and VIX. So let me show you really quick. So you kind of just keep an eyeball of like what your possible exits are. Now, isn't SPY like, is this all-time highs on SPY? Oh wait, no, we had close to all-time highs before. We're close. So let me see really quick. So you always can be aware of your gaps, right? So let me go ahead and do this. So exit target is going to be DD band today. So we're close to all-time highs. We're not there yet. So I don't have these marked, but any gap fills to the downside, no. So there are no open gaps up here. So normally you will have gaps, which are something you'll be able to, it's not my daily chart here. So these are all my old gaps. They've all since been filled. So anytime you have an open gap, right, that's always an exit target. Like an example is here, SPY traded down, gapped up. So on the way down, there's a gap that can be filled here. So these are former ones that have already been filled. Like there's an open gap right here, etc. Right, you see all that? So we gapped up. If there are any gaps down, you would return to them as a place to trade to. So there's really none that are open. So that eliminates that from the consideration today. So that's not an exit target. What is? So we have liquidity pockets, but liquidity pocket is down here. There's nothing in the way. Illiquidity pockets, which would be if there's a bare wall. Again, none of those in the way. And then the last thing we look for is any issues in the VIX. If the VIX were to pivot off of a bull support, I can get out of my long prematurely. So there's nothing in the VIX. So there's no gaps, no liquidity, no illiquidity, no VIX. None of those things work. So the only thing left by default is DD band, which is here. Yes, yes. All right, go out there and have yourself a coffee. Don't get too drunk and enjoy yourself skiing, dude. I'm so jelly. I need to get myself on a ski trip. And you know what we should do? We should do a yearly meetup. That'd be super cool. Speaking of trips, I'm still wanting to do something cool like that. You guys have fun, brother. Yeah, I'm still hanging on for like another 7 points. Until we'll see if I get it. All right. You're getting old DD number in your tab. You here? For NQ, you're getting 4744. That doesn't make any sense for NQ. Yeah, you can pick different contracts, by the way. Make sure you have the right one. You can roll over to the new ones. Daniel says you can't. You can't what? You can't get different contracts. If you click this button, there should be different drop downs. If you're like frozen or locked out or something, just refresh your platform. You just maybe have a weird connection or something to it today. Maybe you disconnected. I just refresh your connection. You're hoping that RS just rolls away and you can use... No, well, it's not going to do that. You, as a trader, you choose when you roll. We don't roll for you. So it's up you, because every trader will do it differently. So there's no standard that we would choose to do that specifically for you. Yeah. I don't understand. You've tried everything. You click this. Yeah, so like if you click something new, the data should show up. If you can show like a screenshot of what you're experiencing, we can look at it. Like I'm gonna pick M24, it changes. H24, it changes. Like you can pick different ones. Yeah, like whatever contract you pick will calculate a DD band for you. This is its own separate tool. So this is a DD band calculator for whatever contract you tell it to calculate for. So that's what the drop downs allow you to pick different contracts. Yours doesn't work. Have you tried a different browser? That's really odd that it wouldn't work because it's just pulling data from the server. We need to investigate your particular connection. So give us, do a screenshot or even maybe a video or whatever your experience. We'll look into it. There's no further sophistication to this other than you change this, we pull the data from the server. You should have full access to that. So that'd be very, Your issue isn't here. Your issue is something else. Yeah, that is weird. I'll look into it for you, brother. You know I will. Right, because this is just pulling from a table from the server, right? Try a different browser first, Daniel. See if it's something with your browser. One of the problems with browsers can sometimes be you can have extensions or issues or something that's going on. Another thing you can do, always, you guys, everyone pay attention real quick. You can go to settings and you can load your default settings. If you got something weird in your cache or something going on, your local settings, your local storage, you can always load the default platform. It's like a factory reset, and that should dislodge most problems. Sometimes you can get a bad save or who knows. Try that, Daniel, and see if that fixes it. And anybody else has any issue? As we roll out updates and new features and new things, sometimes you can have like something just hard coded in there, some kind of setting that's saved that just kind of just muddles things up. Try resetting to default and then see if that dislodges something. You'll lose now. Again, you'll lose all of your layout and settings. You'll have to redo it, but that might fix it. Or try a different browser and then let us know. Yeah. Your connections are all solid. Like if you open up this little tab right here, your status, these are all green, right? And it's odd that some of them work and indexes don't respond. It could be, yeah, like I said, that is definitely odd that some would work and some wouldn't. Yeah, please let us know. Looks like my trade's taken off still further. For that DD band tap right here, so we get it. And let me double check NASDAQ. NASDAQ's getting there, getting close. All right, with that note, I'm gonna get out of here. I love y'all. I'm an hour overdue, or hour late. An hour beyond where we normally quit the stream. So thanks for tuning in. Don't forget, subscribe to the stream, everybody. Subscribe. See us every morning here live and free. Come check us out. We'll trade with you guys watching every morning. You can check us out on a daily basis now. Again, make sure you understand Rocket Scooter is all about inventing a brand new way to see the market. Everything we do here is different. Everything we do here, we made. We're not following anybody's footsteps. We are creating footsteps for people to follow. Volume prediction is the future of analysis. As we pioneer new things, we're glad you could join us on the journey. You get to use our tools with us on a daily basis, and we're glad you support our business and things we're building, bigger things planned for y'all in the future. We love y'all. I'm gonna get out of here. Later. Enjoy your week. Enjoy your ski trips. Enjoy whatever it is you're doing. Holidays this week, of course. Big news week. You know, Tuesday through Friday, we got a lot of big news events coming out. So kind of, you know, be aware that the market might get a little turbulent. So we'll see. But so far, so good. Today, bull market still continues. Things will be great. We'll see y'all tomorrow. Zoom call at 4 o'clock when market closes.